What is driving the substantial working capital requirement among India's top 1500 companies? And what are the stress and pain points among these entities? For answers to all this and much more, stay tuned to the Expert Lounge, a podcast brought to you by India Ratings and Research, a Fitch Group company. Because for opinions on risk and credit, India comes to us. Hi, I'm Siddharth Rego and welcome to the Expert Lounge. In today's podcast, I'm joined by Harshal Agrawal, Senior Analyst at India Ratings, who has recently authored a report on the increasing working capital requirement among India's top 1500 odd companies. Harshal, welcome to the Expert Lounge. It's great to have you here.
Yeah, thank you, Siddharth. My pleasure.
Right. So, Harshal, you have authored this amazing article. Can you just throw some light, firstly, to begin with, on the key methodologies as well as the assumptions which you've used to arrive at the conclusions of this report?
Sure, Siddharth. So, we have done our analysis on top 1500 entities, excluding financial institutions. And basically, for our calculation purposes, we have built two scenarios for FY23, a pre-war scenario and a post-war scenario.
Right.
So in the pre-war scenario, we have considered growth in the financial parameters as per the sectoral estimates, which we envisaged at that time, considering the ebbing pandemic situation, K-shaped recovery in the economy, and moderate inflation.
Interesting, Harshal. And when you say top 1500 companies, that's based on revenue.
Correct.
Right. So this is in the pre-war scenario. What about the post-war scenario, Harshal?
So as you know, like due to war, the supply chain disruptions, we then built up a post-war case where the revenue growth projection was trimmed down. Other financial parameters such as operating revenues, working capital, debt, etc., were subjected to three major macro factors which are running in front of us. First one is buoyant commodity prices. Second is rupee getting weakened. So we have considered 5% weakening.
Okay.
And third is increase in the borrowing cost by 1%, which we have assumed for FY23.
Interesting. So the impact of the buoyant commodity prices, weakening of the rupee, and the increase in borrowing costs have been considered.
Correct.
Right. So, okay. So these are your key assumptions, key methodology, which you have put in place to arrive at your findings. Now, what are the findings? I'm interested to know, Harshal.
So, we have as three major key takeaways I'll say here. First one is a staggering 28% YOY increase in working capital requirement.
28%. Yeah, that is staggering.
Right, for this top 1500 companies. Just to give a perspective, working capital requirement was 8.7 trillion rupees in FY22.
Okay.
Which could have gone up to 9.7 trillion in the pre-war case.
Right.
And then after applying these calculations because of the macro parameters, it could go up to 11.2 trillion in FY23 in the post-war case. That is 28% increase.
So 8.7 to 11.2 in FY23. Right.
And this increase is largely coming not because of substantial demand and product enhancement. It is coming because of the pressures amid buoyant commodity prices, increase in the interest rates, and currency depreciating.
Right.
The second one is the requirements is expected to increase sharply for financial weaker entities.
Okay.
So entities with weak credit metrics having interest coverage ratio of below 1.5 times are expected to witness 3 times jump in working capital requirements.
Interesting.
Just to give a perspective, the working capital requirement was 0.41 trillion in the pre-war case for these entities.
Okay.
Which is expected to increase to 1.26 trillion in the post-war case.
Oh, substantial jump.
Right. And thirdly, in the sectors which are commodity intensive, they are expected to face higher working capital requirements. So sectors such as cement, chemicals, logistics, oil and gas, where the raw material cost form a major proportion of their operating expenses.
Right.
They could face a substantial increase in working capital requirement. Okay. And in fact, the incremental growth in banks' credit that indicates that a significant portion of the new industrial loans are extended as working capital loans recently.
Okay.
And And if you consider second order effect, the increase in fuel power prices will also disproportionately increase the operating cost for entities overall in the manufacturing sector.
Right. So if I have to just understand the key takeaways up till now, one is the staggering increase in working capital requirement around 28% year on year in
Right.
2023. The other point was that the requirements would be increased sharply for the weaker entities, financially weaker entities. And lastly, the commodity intensive sectors could face a higher working capital requirement.
Absolutely.
Right. What about MSMEs, Harshal? How are you seeing that going forward?
Yeah, so we have actually seen significant increase in the receivable days of the MSMEs, even in FY21 and FY22.
Okay.
So the increase in this commodity prices and higher interest rates will only exacerbate their challenges.
Right.
The ECL GS scheme would have helped SMEs absorb such surge in FY21 and FY22. Although the extension of scheme could alleviate some of the stress, the same would put further burden on their debt matrix. Moreover, not every entity would have unutilized limits available for incremental borrowings, is what we feel for MSMEs.
Yeah, I mean, just a broad understanding is there will be a increase in working capital, and so to fund this, I'm sure there would be a lot amount of tailwinds for credit growth. Banks lending to all these entities. So how are you looking at that, Harshal?
Absolutely, you are correct. So this 1.5 trillion increase, which we talked about from 9.7 trillion to 11.2 trillion. Now consider the total bank credit book, which is around 120 trillion rupees.
Right.
And because of the macro events which we discussed, this 1.5 trillion increase is expected to give an impetus of 1.25% to the bank credit growth.
Okay.
So, but considering the current business environment, it requires the lenders to remain cautious about the risks in the credit market.
Oh, that's interesting, Harshal. You mentioned a while back, you covered the commodity intensive sectors and them having a higher working capital requirement. Given that the commodity prices have kind of softened across the last few months, would this alleviate some of the pressure?
Yes, Siddharth, you're correct. The prices have come down slightly, but if you compare it to the levels which we witnessed during FY22 or even during pre-pandemic levels, they are still way above those levels.
Okay.
So in our report, we have plotted multiple commodity prices across the pandemic phase, and it clearly shows that the commodity prices have to pull up significantly to touch the pre-pandemic levels.
Right. Right. So if I have to just sum up whatever you've kind of conveyed to me over the last few minutes, I think the key takeaways would be firstly, there'd be a significant increase in working capital requirement in FY23. Firstly, for your overall corporate base and more so for your financially weaker entities. And then also for commodity intensive entities as well as MSMEs. That is one key takeaway. And the other point which I found was important is this would provide substantial opportunities to banks to lend to all of these entities to fund their working capital requirements. And but given the fact that it's a constantly evolving environment, the bankers would have to keep in mind, most of these risks which you have just mentioned in our conversation, Harshal.
Correct, Siddharth.
Right, Harshal. Thanks so much for joining us on the Expert Lounge. It was great to have you here. And for our listeners, if you'd like a in-depth view on what Harshal just spoke about, you can please click on the link which is circulated along with the podcast. It contains the detailed report authored by Harshal. But until then, do stay tuned to the Expert Lounge. It's a podcast brought to you by India Ratings and Research, a Fitch Group company. Because for opinions on risk and credit, India comes to us.